Imagine money growing while you sleep. It waits patiently while most look the other way. I'll show you where wealth will flow in 2026. A stock is ownership, not a lottery ticket. If the company grows and earns more over time, your ownership becomes more valuable. There are only three real ways stocks make money. First, the company grows and the stock price increases over time. Second, the company pays dividends, which are cash payments to owners. Third, both happen together. Most beginners focus only on price changes, but investors focus on business growth and cash generation. The biggest mistake beginners make is picking random companies. I'll show you where to start. Watch until the end, and you'll learn the golden rule of how to always be in the black. The correct starting point is owning many companies at once. This is done through market funds that track the S&P 500, which represents the largest and most profitable companies in the United States. When you buy this, you own technology, healthcare, finance, energy, and consumer companies at the same time. When one company struggles, others grow and offset the loss. You do not need thousands of dollars to start. Consistency matters more than size. Artificial intelligence and automation. AI is not a single product or application. It is a productivity layer that reduces costs, increases output, and replaces inefficient processes across nearly every industry. The most consistent winners are not consumer-facing AI tools. The investment focus should be on companies selling compute power, storage, chips, and enterprise solutions rather than speculative startups promising breakthroughs. This is where long-term cash flow and scalability exist. NVIDIA, dominant supplier of AI chips and data center hardware. Microsoft, cloud computing, AI integration across enterprise software. Alphabet, AI research, cloud infrastructure, data monetization. Amazon, AWS cloud infrastructure powering AI workloads. ASML, critical chip manufacturing technology, limited competition. Energy transition and power infrastructure. Energy demand is structurally increasing. Electric vehicles, AI data centers, industrial automation, and digital infrastructure all require massive and reliable power supply. This creates sustained demand for utilities, energy storage, nuclear energy, and infrastructure. These investments are less sensitive to political cycles because power consumption grows regardless of policy shifts. These businesses benefit from electrification, data centers, and grid expansion. NextEra Energy, renewable energy and regulated utilities. Duke Energy, stable regulated power generation. Exelon, grid and power distribution. Brookfield, renewable, global renewable infrastructure. Cameco, nuclear fuel supply for long-term base power. Healthcare and longevity. Demographics drive this sector, not market sentiment. Aging populations increase demand for diagnostics, chronic disease management, medical devices, and long-term care solutions. Biotechnology companies with proven pipelines, scalable diagnostics firms, and healthcare data platforms benefit from predictable demand. Healthcare grows because populations age, not because markets are optimistic. Johnson & Johnson, medical devices, pharma, consumer health. AbbVie, strong cash flow and drug pipeline. United Health Group, healthcare services and data. Eli Lilly, innovation in chronic disease treatment. Thermo Fisher Scientific, tools and diagnostics used across biotech. Consumer staples, everyday products. Food and drinks are non-negotiable expenses. Companies operate global distribution networks that are almost impossible to replace. Their brands are embedded in daily life. Even during crises, people continue buying these products. These businesses sell habits, not luxuries. Colgate-Palmolive, toothpaste, hygiene, repeat purchases. Procter & Gamble, household essentials worldwide. Nestle, global food distribution and brands. Coca-Cola, beverage consumption with pricing power. PepsiCo, snacks and drinks with stable demand. The secret is that money grows fastest when it is placed into assets people use every day, regardless of the economy. The strongest long-term investments are not exciting but boring, predictable, and necessary. People may delay buying cars or electronics, but they do not stop brushing teeth, eating food, or drinking beverages. This is where reliable capital growth comes from. Drinks. Drink consumption remains stable across economic cycles. Companies sell products that people consume socially, habitually, and globally. These businesses generate strong cash flow and often pay good dividends. Anheuser-Busch InBev, global beer brands, and cash flow. Diageo, spirits with strong brand loyalty. Heineken, international beer distribution. These businesses tend to stay resilient during recessions. Dividend-paying companies such as Coca-Cola, long dividend history. Johnson & Johnson, consistent dividend growth. Realty Income, monthly dividends backed by real assets. Verizon, cash flow-focused telecom. These examples are starting points for research, not signals. To buy your first stock, you need a brokerage account. One of the most professional and widely used options is Interactive Brokers, often called IBKR. It allows fractional shares, which means you can invest small amounts instead of buying full shares. This makes it accessible even for first-time investors. You can find a link to IBKR in the video description. Do not sell because of fear. After buying your first stock, it is normal to see the price drop 15 or 20%. Your account may show less money than you invested, even though nothing fundamental has changed. Fear pushes people to sell after prices fall, not before, and selling is done to stop discomfort, not because the investment is broken. Markets move in cycles, including growth, corrections, and recoveries, and these declines are part of the market's natural behavior. Temporary drops are not losses unless you sell. When markets fall sharply, most people panic and sell. At the same time, capital is being accumulated quietly. This phase is called accumulation, where prices move sideways or downward while volume increases. Positions are built gradually during this stage. After accumulation comes growth. More buyers enter, momentum builds, and prices rise faster as confidence returns. By the time optimism is obvious, accumulation has already ended. Ignore daily price movements. Ignore social media stock tips or short-term news. Stocks reward patience, not attention. Watching prices too often increases mistakes. Those who hold and add during crisis participate in the entire recovery. How the structure of your portfolio should look like. Core layer. Broad market assets is 40 to 60%. This portion is added to regularly, based on a schedule, regardless of headlines. Growth layer. Sector exposure is 20 to 35% total. That exposure is divided across themes, not concentrated in one bet. For example, AI and automation, energy and healthcare. Cash flow layer. Dividends is 10 to 25%. Dividends are reinvested into the same asset or the core market layer. This increases ownership without new contributions. Optionality layer. High-risk assets is 2 to 8% total. If this layer grows quickly, profits are trimmed back to target size. Avoid to invest your full amount at once. Smart money enters gradually. One portion now, one during pullbacks, and one over time. Defensive layer. Gold during crisis. During market stress, equities and growth assets often decline together. Gold tends to hold value or rise when confidence in risk assets weakens. This is why part of the portfolio is shifted into gold or gold-backed instruments during crisis periods. A practical allocation is 5 to 15%, depending on risk tolerance. Gold is not used for fast growth. It is used to preserve purchasing power. Wealth in 2026 will not be built by chasing noise. It will be built by owning what people need, what produces cash, what survives cycles. That is how capital grows when emotions disappear.